Joining us now for more on the markets and his view that the market pricing of AI-related businesses is a bubble, veteran investor and noted bear Rob Arnott, chairman of Research Affiliates. The firm has $147 billion in assets under management. It is also a sub-advisor to some PIMCO funds. Rob, good to see you.
Wonderful to see you.
So Jamie has been on this line for quite a while, just looking at the potential macroeconomic risks. Meanwhile, you have markets that seem like they're positioned for a pretty benign economic outcome, rising earnings, maybe a soft economic landing, inflation on the downswing. So where do you come in on all that?
Well, what you've described is the narrative that sets where markets are now. The markets are priced based on narratives, and the narrative is a benign outcome. But I think it's wonderful when you look for asymmetries where the market outlook, the break-even inflation rate is 2.3% for the coming decade. That means that, gosh, there should be an equal likelihood of 1.3 or 3.3. You ask 100 people, do you think 1.3 is just as likely as 3.3? 95 of them will say no, 3.3 is more likely. That's an asymmetry. Asymmetries create opportunities. The market is priced for a benign economic environment. And I think Jamie put it really well in saying that could happen, but he doesn't use the words asymmetric risk, but it's clear that that's what he's talking about. Right now you have PMI in its worst quartile. You have inventories in their worst quartile. You have yield curve inversion well into its worst decile. You have rate of change of the cost of capital over the last 3 years in its worst decile. Those are all good indicators of an economic slowdown or recession. Our work calls for 75% risk of slowdown, 25% chance of exceeding past growth rates. Now, that's an asymmetry. So do you want to make bets that maybe inflation is more likely to surprise to the upside, maybe the economy is more likely to surprise to the downside? If you want to make those bets, that says go with value. That says go with diversifiers, the frothy U.S. market. You made the comment, noted bear, I'm a bull on markets that are cheap. And this market isn't cheap.
How does value as a strategy, in terms of exactly what comprises it, mean it's not as susceptible to those potential slowdowns that we might get in the economy? How is it a little more insulated?
Here's a fun factoid that I think 99% of your audience doesn't know. If you look at the Russell 1000 value and you look at Russell 1000 growth, and you look at the growth in earnings of the value portfolio and of the growth portfolio, this century to date, they're nearly identical. Now, how can that be? It's that way for two reasons. One, the gap in growth rates between the two isn't as wide as most people want to believe it is. Secondly, every time Russell rebalances its indexes, some value company has come back into favor, is no longer cheap, it's replaced with a deep discount bargain, and all of a sudden the earnings and dividends of the index pop up with the rebalance. With growth, the opposite happens. You have a fallen angel, it's no longer popular and beloved, it's replaced with a new high flyer. So every rebalance, the earnings and dividends of Russell growth takes a little hit. And that offsets the growth rate differences so that decade to date, growth stocks have been, century to date, growth stocks have been very disappointing. And, value stocks. And value companies have in fact done just fine.